you can argue, when did that bull trend begin? We defined it in February 2016, a couple of months off the low. We said, that's it, it's going up. Bull trend, annual momentum broke out. Price didn't, but momentum did. But then it labored for a couple years, between 1360 price, and it even probed back down in late 2018 to within over 50, $60 of the prior low that occurred in 2015, which was around 1,050. So then in late 2018, you pushed up through that price base, 1360, call it roughly, and price really broke out. So you can define it there. Maybe it started in late 2018-19, but we defined it as early 2016. Okay, forget that. It's aged compared to a couple other bull markets we've had in the past, which were 8-9 years old, that kind of thing. Mid-70s to 1980, the 2000 low to 2011. So it's a decade involved there. So we're now 9 years, but we have different fundamentals than we've ever had before. We've also got better technical dynamics. So I think silver is at some point going to engage in a way that will drop jaws, okay, in terms of its performance to gold. We call it a little dog on a leash to Mama Gold. Mama's holding a leash, and silver will run ahead of it, and then silver will run behind it. Today is the behind day, okay. Silver's down more than gold by 1% or 2. But that's common. It's been common for the last couple of years, where silver does follow gold, but it goes ahead, goes behind. There's a point at which, though, not far above current spread levels. And what we do is we measure the price of silver versus gold in terms of dollars per ounce versus dollars per ounce. So right now, silver's about 1.23 or something, the price of gold, 1.23%. If you get up to about 1.3%, we've got technical reasons to assume you're going to blast. In other words, the silver-gold spread will unleash, not just for a few days, but probably likely months, several months. And that's what occurred in 1979 in the final year up to 1980 peak. And it also occurred in 2010-11 in the final year up in that bull market, where silver broke out on its spread basis versus gold and really unleashed. So yes, it's attached to the leash held by gold, but it can really pull out in front. And it tends to do that in the very dramatic phases of the price rise in both metals. So if that spread breaks out, and we think it's headed toward the breakout level again, roughly 1.3%. You see it up to that level, where you divide the ounce of silver, the December silver and the December gold, and you come up with a 1.3%. Put your helmet on. Because at that point, I think silver is going to engage far more dramatically than gold. I think we're going to do it. We're still below that level, but it's a level to be watched, and it will engage price as well, not merely the performance difference between the two. I think the S&P and the NASDAQ, and this is true with some other indices around the world. We've looked at the DAX index in Germany, Nikkei, Sensex in India. They all have technical vulnerabilities by our momentum metrics. Not the price chart doesn't show it. S&P right now is starting to break some annual momentum trend structures. Quarterly momentum trend structures, meaning when you measure its month-to-month action in relation to a 3-quarter moving average, which is a fairly long-term average. It's almost like a 200-day in terms of the duration, the size of the metric. You're breaking a structure now that goes back a year or so on that quarterly momentum, such that when you trigger that, and right now you're at levels where you close the week here, you're triggering it, okay? You're going to unleash to the downside. Now, I don't think you're going to crash. I think we're headed into a major next downturn in the stock market. Whereas I think MSA argues that the 2022 highs, which have been exceeded by double-digit percents, but it took them 2 years to get back there, and then finally they took it out. We think that takeout of those highs is a trap. It's a mega trap. It has generated the forever upward sentiment. And we think all it's done is extend the bubble. This is the biggest stock market bubble in U.S. history. You can go back to 29, look at that high. It was a four-year bull market, or 5-6-year bull market from the 23 low. But it only doubled or tripled in price. You go back and look at the 2000 .com peak. That was from about 1994 to about 6 years. Okay, and the S&P like doubled or tripled. Okay, then you go back to 2002 lows to the 2007 high, 5 years. S&P doubled. Those were the prior bull market peaks that led to collapses that generated pain, not just to stock investors, but to people in the real world. Okay, we've had a bull market since the 2009 low. Okay, more years than ever before, and the multiples are off the page. S&P's gone up 7-8-fold, Nasdaq's gone up 16-18-fold. Okay, you've never seen those kind of dimensions. Now you could say, oh, it's good economy. Well, look at M2 and see the rapid money printing over the last decade, for example, compared to prior decades. And look at the Fed funds rate for the last 15 years, where 10 of those years were at zero. Okay, free money. Okay, that has caused a bubble. The boom-bust cycle is a monetary phenomenon. When it breaks, the errors will be exposed, and at that point, that's when the monetary metals go absolutely berserk, because this time the bubble is bigger than ever, and this time around we also have a crisis in debt involving U.S. government. It's no longer just mortgages. So watch the stock market. There might be, and we think there will be, a flash from the T-bond market to the upside where yields actually drop. Right now they're rising. Despite the Fed cut in September, bond prices have come down sharply. That has no doubt unnerved the Fed. Stock market now starting to break will cause data points to cave next month, the following month. That's what happens. When the market goes down, then the data points shift. The Fed will panic. Gold knows that. What does it mean? Further monetary expansion, drop in rates below where they might otherwise be in a free market. And this is true not just with our central bank, but the ECB, the BOJ, et cetera, et cetera. So gold knows there's another monetary infusion coming, meaning further degradation in the value of the money. Okay, that's what gold lives on. Okay, so ultimately watch the stock market. It was a good point you made, because if it cracks, and we think it's about to blow major structures that should cause a layered sharp drop, not a 35% drop in 2 weeks, which is a crash. We think right now you could get a 10 or 15% drop in the stock market quickly. That's not a crash. Right now, one of the problems with the gold and silver investors is they have this syndrome that, oh, if the stock market goes down, see, like today, for example, gold and silver must go down. Don't bet on it. You go back and look at the 2007 bull top in S&P, by the way, which occurred 1 month after the first rate cut by the Fed, a surprise rate cut in September of 2007, just like September of this year. S&P went up for the next month, and in October peaked. Okay, well, did we just peak in October, a month after the Fed cut? Anyway, we have momentum structures that say the U.S. stock market and other markets could cave very sharply and move money out of that category into the place that's working the best. What is that? Monetary metals. When you look at the hourly action of the S&P, of the silver and the gold markets, you look at this morning, for example. When do they beat it up? It's always in the dark. As you're about to go to daylight, early in the morning when they open the futures market, they've already dumped on the market during the night when trading is less volume. And you get these huge down hourly bars. But it always occurs like in the dark, when they can manipulate easily. Ultimately, that's going to backfire. And also, stand back and look at it. I've got some charts showing year-to-date performance of the markets. And you see the S&P and the Nasdaq up, 10, 15%, pushing on 20. They're backing off right now. They were near their highs. It wouldn't shock me at the end of the year they're down on the year. But silver's up 35%, gold's up about 33% on the year-to-date. Okay, so despite the manipulation, which you can probably see in daily action, maybe today, for example, look at the gains they've made. So really, it's not working. If it were, gold wouldn't be up 30+% this year. Silver up 35. So ultimately, there's a point at which that manipulation doesn't work at all, and market just blows through them. And ultimately, the manipulation likely compresses the volatility that later is unleashed, where if reality is distorted and you've kept reality from emerging, when it finally does emerge, it's more volcanic than it would have been if you'd let it alone. Okay, so Actually, it's probably bullish for gold and silver investors that the central banks think they can play that game.